Trailing commissions. Many mutual funds sold in Canada have what are called trailing commissions. Trailing commissions are an indirect cost borne by investors that are intended to compensate investment dealers and financial advisors for providing you with advice and service. Let's see how trailing commissions work by working through an example. Let's suppose you have $100,000 invested in a mutual fund. This particular mutual fund has a management expense ratio, known as an MER, of 2.2%, and it pays a trailing commission of 1%. This 1% comes out of the MER. For argument's sake, let's say that this fund's reported value didn't change throughout the year. You had $100,000 in the fund on January 1st, and by December 31st of the same year, it was also valued at $100,000. To roughly calculate the expenses you paid for this fund over the course of the year, we take the value invested, $100,000, and multiply by the 2.2% MER to get $2,200. From this $2,200, the mutual fund manufacturer paid $1,000 to your investment dealer. That's the financial institution your financial advisor works with, and that $1,000 is split between the investment dealer and the financial advisor. That is the trailing commission. All of these costs would be incurred every year that you own the fund. It's important to note that trailing commissions are incurred over and above other types of commissions generated associated with mutual funds, such as front-end sales commissions or deferred sales charge commissions. The amount of trailing commissions charged varies. They are typically in the range of 0.25% to 1% per year, but can be even higher in some cases. Some mutual funds do not pay trailing commissions. It's important to note that costs, whether direct or indirect, will reduce the value of your investments over time. As an example, let's compare two similar funds that only differ in annual costs. Mutual Fund A is a higher cost fund and has an MER of 2.5%. And Mutual Fund B is a lower cost fund and has an MER of 1.5%. They both invest in Canadian stocks and before expenses both attain a rate of return of 7.5% for the next 25 years. We invest $50,000 into each fund. At the end of 25 years, the value of Mutual Fund A is $170,000, rounding to the nearest thousand. The value of Mutual Fund B is $215,000. This seemingly innocuous 1% difference in cost translated to a $45,000 difference in ending value. Even the lower cost fund incurred costs to the investor over those 25 years of $43,000. Understanding costs is important so that you can measure that against the value you are receiving.